Imagine waking up to a letter saying your property taxes just doubled. Or worse, you could lose your home because of a change in tax law. Sounds extreme? Well, it's closer to reality than you think. Starting March 2026, millions of homeowners could face a financial nightmare as new tax laws take effect. From losing crucial property tax deductions to skyrocketing capital gains taxes, these changes could change everything. But don't panic yet. If you know what to expect, you can take action now to protect your home. Keep watching to find out what's at stake and how you can safeguard your future.
Number 1. Elimination of property tax deductions. Starting in March 2026, one of the most significant tax changes homeowners will face is the elimination of property tax deductions. For many, these deductions have been a lifeline, helping to offset the burden of rising property taxes. Historically, homeowners could deduct the amount they paid in local property taxes from their federal income taxes, but with this change, millions could see their tax bills skyrocket. The reason this matters is simple. Many people, especially in high tax areas, have used property tax deductions to reduce their taxable income. If you're someone who relies on this deduction to ease your financial load, this change could cost you thousands of dollars annually. For homeowners in areas with higher property taxes, such as New York or California, this will be a huge financial blow. Research shows that up to 30% of taxpayers use property tax deductions, meaning a significant portion of the population will be directly impacted by this change. It's crucial to understand that these changes won't just affect those who are well off. Middle-class homeowners are especially at risk. In some cases, people could even find it difficult to afford their homes after this increase. For example, a family in a high tax area might face a jump in tax liability simply due to the loss of this deduction. And while some may argue that the tax cuts elsewhere may balance it out, the reality is that property tax rates will keep rising, and without the deductions, the burden will be heavier. So, what can you do now to prepare? Start by reviewing your current tax situation and talking to a tax advisor about strategies to minimize the impact. You may need to make changes to your financial planning and start thinking about how to adjust your budget in anticipation of these higher taxes. Act now to avoid being blindsided when the changes were allowed in 2026. Number 2. Changes to mortgage interest deductions. Another key change coming in March 2026 is the modification of mortgage interest deductions. Currently, homeowners can deduct interest paid on their mortgages, but these deductions are about to be limited. For many, the ability to write off mortgage interest has been a vital tax relief tool. It has helped make homeownership more affordable by reducing the overall tax burden. However, starting in 2026, only those with mortgages under a certain threshold will be able to fully benefit from this deduction. This means that higher-income homeowners, or those with larger mortgages, may find themselves paying substantially more in taxes. For example, if your mortgage exceeds the new limits, you may no longer be able to deduct the full interest you pay. This could significantly increase your tax liability, especially if you live in an area with high property values and have a larger mortgage to match. Financial experts predict that the change could lead to higher effective tax rates for homeowners who were previously benefiting from this deduction. The impact on your monthly finances could be noticeable. The loss of this deduction might force homeowners to either adjust their budgets or find new ways to save money. If you were relying on the mortgage interest deduction to help manage your expenses, these changes could affect your ability to keep up with payments or maintain your standard of living. While it's difficult to predict exact figures, some experts suggest that certain homeowners could face tax increases in the thousands of dollars. So, what should you do to minimize the impact of these changes? Start by considering options like refinancing your mortgage to a lower amount, or if you're purchasing a new home, be mindful of the mortgage size you choose. Now it's also a good time to speak with a tax professional who can guide you on ways to restructure your finances and protect yourself from these upcoming changes.
Number 3. Changes to capital gains tax for home sales. If you've been thinking about selling your home in the near future, capital gains tax changes are another major concern under the new tax law set from March 2026. Currently, homeowners can exclude up to $250,000,
$500,000 for married couples in capital gains from the sale of their primary residence, provided they meet certain requirements. However, the new rules will lower the exemption limit significantly, meaning that you could end up paying substantially more taxes on any profit from selling your home. For example, imagine selling your home and making a profit of $300,000. Under current tax laws, if you meet the criteria, the first $250,000 of that gain could be tax-free. But with the new rules, you may only be able to exclude a portion of that profit, which means a larger taxable gain. The tax burden could be even higher depending on the sale price and your tax bracket, particularly if you've owned the home for a long time and the market has driven its value up significantly. This change could impact homeowners who plan to sell their property in the next few years to downsize, move for a new job, or even cash out their equity for other investments. The increased capital gains tax could make it more difficult to realize the same amount of profit from your home sale as in previous years. In some cases, this could force homeowners to rethink their selling strategies, potentially holding off on selling or adjusting their asking prices to cover the higher tax costs. What should you do now? Consider selling your home before the tax changes take effect in 2026. If you're planning to sell, now may be the time to lock in a deal and benefit from the current capital gains tax exemption. Consult a tax advisor for personalized advice on how to minimize your exposure to capital gains taxes and protect your profits. Making strategic decisions now can help you avoid being hit with a massive tax bill when you sell. Number 4. New estate and inheritance tax changes. One of the most worrying tax changes in 2026 revolves around estate and inheritance taxes. For homeowners who plan to pass down their property to family members, these new changes could have significant consequences. Estate tax exemptions, which allow heirs to inherit property without being hit with large tax bills, are set to decrease dramatically. This means that loved ones who inherit your home could face higher tax obligations than before. Currently, the estate tax exemption allows individuals to pass down up to $12.92 million in assets without incurring federal estate taxes, and for couples, that number is double. But under the new rules, this exemption amount will be reduced significantly, which means that many families could find themselves owing substantial taxes when they inherit property. For homeowners in high-value markets like California or New York, this could create financial challenges for heirs who may not have the liquidity to cover these unexpected costs. For example, if your estate exceeds the new exemption threshold, your heirs could be forced to sell the family home just to pay the taxes. In some cases, family homes may end up being liquidated, splitting up assets that would have stayed in the family for generations. This is especially concerning for families who may not have the financial resources to handle the inheritance taxes. The potential to lose a long-held family property to taxes could become a harsh reality for many. So how can you prepare? First, review your estate plan as soon as possible and talk to an estate planner about how these changes will impact your situation. Strategies like setting up trusts, gifting property before death, or rethinking how you structure your assets could help mitigate the impact of inheritance taxes. Taking action now can protect your family from being forced to sell your home due to these upcoming changes.
Number 5. Changes to homeowners' insurance deductibility. A significant but often overlooked change coming in 2026 is the shift in how homeowners' insurance premiums will be treated for tax purposes. Currently, some homeowners are able to deduct a portion of their homeowners' insurance premiums if they meet specific conditions. However, with the new tax laws, the deductibility of these premiums is set to be scaled back, particularly for higher-income households. This could place a strain on homeowners who rely on these deductions to manage the cost of their insurance, especially in areas with high insurance premiums due to natural disaster risks or property value. For instance, if you live in an area prone to wildfires, floods, or hurricanes, your homeowner's insurance could already be quite expensive. With the new tax rules, you may no longer be able to deduct these premiums in the same way, leading to higher out-of-pocket costs for maintaining coverage. Homeowners in higher risk areas will feel the impact more severely as they could see their insurance premiums rise while the tax relief they once counted on diminishes.
The financial consequences of this change could be particularly challenging for those on a fixed income or those already struggling with the rising cost of living. Without the ability to offset insurance costs through tax deductions, many homeowners might find themselves choosing between keeping their property insured or cutting necessary expenses. What can you do to protect yourself? Review your insurance policy and see if there are ways to lower premiums without sacrificing coverage. Shop around for better rates, especially if your insurer is raising prices. Also, start consulting with a tax professional about how to plan for the loss of this deduction in your upcoming tax filings. By acting now, you can minimize the impact of these changes and ensure you're not caught off guard when the new rules take effect.
Number 6. New property value assessments. One of the more subtle but impactful tax changes coming in 2026 involves new property value assessments. Property taxes are typically based on the assessed value of your home, and local governments are often responsible for determining this value. Under the upcoming tax reforms, many states are introducing changes to how they assess property values, potentially leading to higher valuations and therefore higher property taxes. This means that even if your home's value hasn't changed significantly, the way it is assessed might make it appear worth more on paper. For instance, counties and municipalities might adopt new methods of assessment, such as using more current market data or adjusting for inflation, which could lead to an increase in your property's assessed value. As a result, homeowners might see an unexpected hike in their property taxes, despite the fact that the market value of their home has stayed the same or even decreased. In areas where property values have been rising rapidly, these changes could be particularly painful. Homeowners who have seen significant appreciation in their property value may face even higher assessments, potentially pushing them into a new tax bracket. This could lead to a substantial increase in property taxes, especially in areas with high demand and limited housing stock. In some cases, these rising taxes could make it difficult for homeowners to keep up with their payments, forcing them to either sell or face financial hardship. What can you do to stay ahead of this change? The first step is to monitor your property's assessment regularly. If you believe the assessed value is too high, you may be able to challenge it through an appeal process. This can help you avoid overpaying on taxes. Additionally, research the property tax laws in your state and locality to understand how these changes may affect you and what steps you can take to mitigate the financial impact. Being proactive can save you from the shock of higher property tax bills down the road.
Number 7. Changes to tax benefits for second homes. If you own a second home, whether it's a vacation property or an investment property, the new tax laws set to roll out in March 2026 will likely impact you significantly. Historically, homeowners could take advantage of certain tax benefits related to second homes, including deductions for mortgage interest and property taxes, as well as capital gains exclusions under certain conditions. However, under the new tax regime, many of these benefits will be either reduced or eliminated altogether, making second homes much less financially appealing. For example, the new rules will limit the ability to deduct mortgage interest on second homes, particularly for homes that are not used as primary residences or rental properties. This means that those who have second homes as vacation getaways or weekend retreats could see their tax deduction shrink, leading to higher taxable income. In addition, certain capital gains exclusions for second home sales could also be scaled back, meaning you might be taxed more heavily on the sale of a second property. The changes could hit those who rely on second homes for rental income particularly hard. Investors who purchase homes specifically to rent them out will also see a reduction in tax benefits, which could reduce the overall profitability of rental properties. For individuals who have been using their second homes as a source of passive income, these adjustments might make it less worthwhile to own multiple properties, especially if the tax savings are no longer available to offset maintenance and management costs. So, what can you do? If you own a second home, now is the time to reassess your financial goals. If you're thinking of selling, it may be worth considering doing so before 2026 to avoid higher taxes on capital gains. For those looking to hold on to their second homes, it's advisable to consult with a tax professional to better understand how these changes might affect your finances and explore ways to maximize your investment in light of the new laws.
Number 8. Impact on retirement account withdrawals for home purchases. In a major shift, the new tax laws set to take effect in March 2026 will impose stricter rules on retirement account withdrawals, particularly when using funds to purchase a home. Currently, many homeowners are allowed to use their retirement savings, such as funds from an IRA or 401k, to cover the cost of buying a first home without incurring the usual early withdrawal penalties. Under the new rules, however, these withdrawals will become subject to higher penalties or restrictions, limiting how much you can access for a home purchase without facing a substantial tax burden. For many first-time homebuyers, this change is a serious concern. As it stands, the penalty-free withdrawal option for first-time homebuyers allows up to $10,000 from an IRA, but with the updated laws, the threshold could be lowered or the penalties could be increased. This could prevent many from using their retirement savings to get into the housing market. For those relying on these accounts to fund their down payments, it may mean coming up with the money from other sources, such as savings, loans, or potentially higher interest debt. Additionally, homeowners who are not first-time buyers but have been using retirement funds to finance home improvements or purchase a second property may also face stricter penalties on withdrawals. If you've been relying on these funds to improve or buy property, these changes could disrupt your financial strategy and lead to higher taxes or reduced savings for your future retirement. The higher penalties could make it less attractive to tap into your retirement account for home-related purchases, forcing homeowners to rethink their financing options. So, how can you prepare? Start exploring other funding options for your home purchase or improvements now. If you plan to use retirement savings for such purposes, consult a tax professional to see if there are alternative strategies that could help you avoid penalties. This change could affect many individuals, but with proper planning, you can mitigate its impact and still achieve your home ownership or property goals.
Number 9. Stricter tax enforcement for real estate transactions. Starting in 2026, homeowners and real estate investors should prepare for stricter tax enforcement regarding property transactions. The IRS is set to ramp up its focus on real estate, particularly with regards to property flipping, capital gains reporting, and rental income. In recent years, the government has already been increasing its scrutiny of real estate transactions to prevent tax evasion, and the new tax laws will only intensify this effort. For example, if you're selling or flipping a property, the IRS will be keeping a closer eye on the capital gains taxes you report, ensuring that they align with market prices and transaction details. Similarly, if you own rental properties, you may face more rigorous audits regarding the income you report and any deductions you claim for maintenance, repairs, or depreciation. The potential for increased audits could make it more difficult to hide income or undervalue your property for tax purposes. This heightened scrutiny may not only result in higher taxes, but could also lead to penalties or fines for those caught in violations. So what does this mean for everyday homeowners? If you've been involved in real estate transactions, whether buying, selling, or renting, there's a higher chance you could be audited or questioned about the details of your sale or rental income. This could create a higher administrative burden and cause delays in your transactions. Even minor errors or omissions in your tax filings could now lead to bigger problems, including financial penalties or legal issues. So how should you prepare? First and foremost, it's time to keep detailed and organized records of all real estate transactions. Document every sale, purchase, and rental agreement, along with associated expenses. If you've been involved in flipping properties or claiming deductions for rental properties, consult with a tax advisor to ensure you're fully compliant with the new enforcement rules. Proper preparation and understanding of the laws will help protect you from the increased scrutiny that's coming.
Number 10. Changes to local property tax laws. In addition to federal tax reforms, local property tax laws are undergoing significant changes that could have a substantial impact on homeowners starting in March 2026. Many local governments are revising their property tax regulations, and the changes could vary widely depending on where you live. This means that homeowners could face higher property tax rates or different assessment methods, resulting in unpredictable tax increases. One major shift is the introduction of automatic property tax increases tied to inflation or market conditions.
In some areas, property taxes will automatically increase each year based on local market data without any voter input or public hearings. This could make your property taxes rise even if your home's value hasn't changed significantly. And in some cases, it might cause your tax burden to skyrocket unexpectedly. Additionally, revenue-focused changes in many municipalities may lead to new fees or taxes designed to fill budget gaps, further impacting homeowners' financial stability. For example, homeowners in states like Texas or Florida, where property taxes are already high, might see steeper increases as local governments adjust their tax systems. In cities where property values are rising rapidly, the new assessments could push homeowners into higher tax brackets, even if their property value hasn't dramatically changed. Additionally, some areas might start using digital property assessments, which could lead to more frequent reevaluations and sudden tax hikes. So, how can you stay ahead of these changes? Stay informed about local tax law updates and be proactive in reviewing your property's assessment. In many places, you have the right to appeal a tax increase or an assessment you believe is inaccurate. Consult with a local tax expert to understand the specifics of your region's tax changes and find out if you qualify for any tax relief programs that could help you offset the rising costs. By being proactive, you can avoid surprises and potentially save thousands in property taxes.
As we've seen, the tax changes coming in 2026 are not just minor tweaks, they're major shifts that could directly affect millions of homeowners. From the elimination of property tax deductions to higher capital gains taxes on home sales, the impact of these changes could be felt in every aspect of your financial life. Homeowners will need to adapt to new tax laws and assessments to avoid being caught off guard. Whether you're planning to sell, buy, or even pass down your home to future generations, taking action now could make a significant difference in how much you pay in taxes down the road. In these uncertain times, it's more important than ever to stay informed and prepared. Consult with professionals, review your financial plans, and explore ways to minimize the impact of these changes. The more proactive you are, the better you can protect your home in your future. Don't wait until the last minute to make adjustments. The new rules are coming soon, and understanding them today could save you from financial stress tomorrow. We'd love to hear your thoughts on these upcoming tax changes. How do you think they'll impact you? Drop your comments below. And if you found this video helpful, don't forget to check out our previous videos for more insights. Your support means the world to us as we put a lot of effort into creating these videos, so please subscribe to our channel. It's just one click, and it helps us keep making great content for you.